and thank you for joining us today for our Financial Wellness Mindfulness Matters panel. I have two lovely ladies in front of me that I will introduce you in just a moment, but today's session is titled Stimulus Checks, Taxes, and IRAs. Oh my, how clever. So I am Lauren, and I am one of the co-founders of Focus on Health. We are a company that really works and advocates for the health and wellness of food and beverage individuals. You can check us out at fohealth.org. I'm really excited to be talking today with these two lovely ladies about mindfulness and financial wellness and responsibility. So I'm going to read a few definitions of financial wellness from various organizations. Financial wellness involves the process of learning how to successfully manage financial expenses, UC Davis. Financial wellness is defined as effectively managing your economic life, Questis. And finally, well-being is defined as having financial security and financial freedom of choice in the present and in the future. That's from the Consumer Financial Protection Bureau. So financial wellness requires action, not just learning in the classroom. While financial discernment is without a doubt necessary for financial well-being, an application of that knowledge is required to modify habits for the better. For example, knowledge of a 401k plan is great and puts you ahead of most people, but without exploring the retirement saving options that are specific to your situation, that knowledge will be of no use and leave you as unprepared for retirement as someone who is financially illiterate. And that is so true. So we need to ensure that these resources that we have are specific to our situations, right? So today's two panelists are Naomi and Cameron. I'm going to let them introduce themselves and then we will get started. Cameron, would you like to start?
Sure. My name is Cameron Nevue. I am a certified public accountant. I have been practicing in the tax realm primarily for the last 13 years. I graduated from James Madison University with a degree in accounting, and then while working, obtained my master's in tax from American University in Washington, D.C. I am very excited to be here today to talk about this topic. It is very near and dear to my heart.
Thank you for being here. And next is Naomi.
Hey, I'm Naomi Levy. I'm a bartender and bar and restaurant consultant based out of Boston, Massachusetts. And I have been doing a lot of advocacy for financial health in the hospitality business for quite some time now, helping folks figure out how to navigate this with the help of lovely professionals such as Cameron. I'm really excited to be here. Thanks for having me.
Yeah, so today's panel is going to be really great, and I'm very excited to have them both here. Back in November, we asked you all a few questions, and these questions will be answered today, so stay tuned for that. But I wanted to start the conversation off by asking Cameron a question. How do you define financial responsibility?
So, financial wellness responsibility is going to be very individualized to the person. And I think you have to sit back and evaluate where your comfort levels are. And this includes evaluating your risk tolerance, meaning, if I have money in the bank, am I comfortable investing it in the market, the stock market? Am I comfortable putting it away for retirement, not needing it in the future? So really, it's a multifaceted process that I think, everyone needs to evaluate for themselves. But I think what we're going to cover here today is a few tidbits of help that can, apply to the broader population.
Yeah, absolutely. And Naomi, thinking of the way all of these organizations defined financial wellness, and then also hearing Cameron, speak to financial responsibility, what do you think this looks like in the food and beverage sector, or what part it plays?
Yeah, so I think this is really important for us to think about as hospitality workers. We work in a field that, tends to not actually put a lot of focus on having healthy financials. There's money burning a hole in your pocket, but that's not sustainable for us. So for us, it's really important to do a little extra work. We don't have as many of the support systems financially in place as some of our friends and family that work in more corporate or traditional white collar environments where a lot of that's offered for them. So it's up to us to kind of do a little bit more of that research, to take on a little bit more of that responsibility so that we can really take care of ourselves now and in the future. So speaking of taking care of ourselves now, so I have a bunch of questions for Cameron. It's really great to have her at our disposal today. So I want to start off just with, especially now, a lot of us, have needed a little bit of help. And the big thing in the news has been stimulus checks. So we've all heard about the stimulus checks. Some of us have gotten them, some of us haven't. Some of us have gotten different amounts than we thought we were going to get. What's this all about with the stimulus checks?
Yeah, sure. So the stimulus checks, we're reading in the media, $1,200 per taxpayer plus additional if you have children. And some people may have not gotten any money, and others may have gotten some amount that's not equal to what you were reading. And I want to put everybody at ease in the sense that if you haven't received it, or you've gotten an amount that maybe you thought was a little too low, the entire stimulus check calculation is going to be reconciled on your 2020 tax return. So there will be a line item, and if you qualify for the full amount of the stimulus, any amount that you were shorted or did not receive will be given to you when you file the 2020 tax return. So some reasons you may not have gotten it is if you were maybe delinquent in some prior years where you didn't file taxes, or maybe income amounts didn't reconcile with the Treasury records, or, there could be odd instances why people didn't receive the stimulus checks. But as I mentioned, if you file your 2020 tax return, the proper amount will be calculated there, and you will receive any money you are owed once you file that return.
That's great news. All right, well, so speaking of 2020, it's been a crazy year for a lot of us. I know myself, I was unemployed for a little while. I got unemployment. I got a PPP because I'm also self-employed for part of my income. So what do I need to do? What kind of documents should I try and gather to prepare to file my 2020 taxes with all these kind of different things going on this year?
That's a great question. So you're going to want to, you'll receive a 1099 form from the government where you received your unemployment. And if everyone wasn't already going through enough, unemployment compensation is taxable. So if you didn't have any taxes withheld, I would just be prepared to see a number that you may have to pay in on that unemployment compensation, which it's just tragic, but that's the rules are, the IRS says any income from whatever source derived, and unfortunately unemployment compensation falls into that category. I don't want to cover PPP loans, but they can be forgiven. There's an option to apply for forgiveness of those loans for anybody who did qualify to earn one of those. And some other documents, you're going to want to make sure you get that W-2 from the employer that decided to, let you go, which might be kind of hard to track down if you move. So just stay on top of things. You might have to be more proactive than in years prior, reaching out to employers and things to get those tax forms. If you can't get them, no matter what, you can get them from the IRS. There's a process to request your tax transcripts. So if at the very minimum, you can't get them from anybody that you worked for, the option would be to go directly to the IRS to get them.
So you mentioned that I might owe if I didn't have my unemployment taxes taken out ahead of time. What are some other situations where I might owe taxes?
If you report your tips and your employer didn't withhold taxes on those tips that you reported.
Got it. Or would that mean say I walk with cash tips and there wasn't and I always have a $0 check, would that probably mean I might owe?
Yes, if you report those taxes on your tax return, which you are required to do per the Internal Revenue Code. Some other reasons you might want to report your tips. Well, you're required to report your tips, but an advantage of doing so is, if you want to apply for loans or, want to qualify to be able to buy a home someday or buy a car, some of those things are based upon your income levels. And so reporting your tips in their entirety would allow you to qualify for, a nicer home or a nicer car.
Got it. Was how my tips declared, did that affect unemployment?
If you declare your tips, or when you declare your tips, it will increase your unemployment because it's included in your base wage calculation. So all states have a base wage period, and the more wages you can report or demonstrate will provide you larger unemployment benefits down the road.
Okay, so my employer, and you mentioned this, so my employer declares my tips for me, but if I look on my pay stub, it's actually less than what I was making. So how would I change that?
Well, you can just true it up yourself on your own tax return when you file. You can say, so let's say your employer does 70% of your tips, and so there's an additional 30% that you want to report, so that you can, start to build your credit, build your equity. You would just put that on your tax return.
Cool. Okay, so you mentioned getting loans as well as another reason I might want to declare my tips, but I thought loans were really based on credit. So what is credit and how do I get it?
Yeah, so loans are based on your credit and your income. That's exactly right. And so we talked about one piece of that. Reporting your income on your tax return is one way to demonstrate that you are a credible loanee, and you would you'd be a good qualifier for the loan. Another place would be your credit cards, right? So building your credit score through having a credit balance via credit cards is how you build some credit score. One thing, a piece of advice, that, and it doesn't work for everyone, but when you think about financial wellness, it's would be advised by some of the professionals to say, let's pay off our debt first, right? We'll pay off our debt, and then we'll save 2.5 months of expenses in a savings account. And then step 3 would be moving forward, future planning, retirement, equity investments, things like that, right? So if we focus on step 1, one thing that will hurt your credit score is carrying a credit card balance.
Got it. So I want to spend money on my credit cards, but then I should pay them off in full and not carry any sort of debt for them. And that's going to build my good credit score.
That's definitely going to be a big step in helping build that good credit score. The other thing that you want to do, so the amount of credit that you get on a credit card is correlated to your income. Another reason to report all the money that you earn. Helping build the credit score is using a lower ratio of your credit ability. So let's say your credit card, you can spend $5,000. If every month you max out $5,000, your credit score is not going to go up. The best tactic there would be to spend some amount, $1,000, $500, $1,200, $1,500 of that $5,000, showing that you are financially responsible and can pay off what they've given you. So then what happens is you have that track record of paying off and not using the whole credit liability, just a piece of it. That builds your credit. Paying it off right away builds your credit. Just shows that you're financially responsible, and then that will lead to obtaining home loans, car loans, things like that.
Cool. So what about savings? So I'm spending a little money on credit cards, I'm paying it off every single month. But if I want to buy something, I guess I need some money. So why should I be saving?
Right. So we've talked about sort of the 3 pillars. So we don't want to focus on saving till we've paid off the debt, at least the high interest rate debt, right? Some debt is okay. School loans, for example, are an okay form of debt. Then what you want to do is try to save 2.5 months of your monthly expenditures. So that would be rent, utilities, car payments, cell phone, things like that. You want 2.5 months saved in a savings account that's there for emergencies. So unemployment would be the definition of an emergency. You'd need to tap into that to help pay some bills. Could be an illness. Could be having to leave a job to care for someone that you love because they're ill. So those are some examples of why you want that nest of money there.
What's the best place? Like, do I just open a savings account at the bank? Like, what are my options for where I put this money?
I think, and this is just my opinion, but the best place is just like a checking or savings account. And then what I do for mine, and this is totally personal, I don't have a debit card, and I have no ATM access to my savings account. And I do that so that I can't touch my nest egg. So that 2.5 months savings that I have for emergencies is only accessible if I physically go into the bank to withdraw it, which means I'm there because stuff is bad. Like, situation is bad and I need that money. So that's what I do. That would be what I would advise.
So you can touch that money, but you don't. You make it hard for yourself. I love that idea. Mm-hmm. Yeah. So, okay, well, what about, so there's savings just like for an emergency. What if I'm like trying to, invest or try to earn some money because I have a big purchase that I want to make, like a car or a home, something I need a big down payment for?
Yeah, so this comes down to evaluating really where you're at on that risk tolerance scale, right? So if a home purchase is 5 years out, let's say 5 years or more, then I would say that the money that you save, you would want to try to invest more wisely. Again, this comes down to your tolerance, though, because in the stock market, nothing is guaranteed. So you could lose all of the money as well. But when you're thinking long term, generally equity investments, which is the stock market or mutual funds, have a greater return in the long run. There's definitely no guarantee that they have a good return in the short term. So if your home purchase is closer than that, you're going to want to probably just keep it in a savings account. Maybe do it in addition to your 2.5 months of expenses.
Got it. So short-term goals, savings account, long-term goals, stocks and funds and stuff like that. And so those long-term goals are retirement. Should I just put like as much money as I can in the retirement and not as much in my savings, or?
Yeah, so retirement is a good topic that we should talk about. So there's a couple options for retirement, but I would say anything that you put into retirement, you have to be prepared to not touch until you're 59 and a half. And the reason for that is if you withdraw money from a IRA account, a traditional IRA account, before you reach age 59 and a half, you will pay income taxes on all that money that you didn't pay taxes on when you put it in there to save it. And you will also pay 10% penalty. And that's just a waste of money. I mean, sometimes there are exceptions to pulling out from your retirement accounts, like a first-time home purchase is actually an exception that you won't be subject to that 10% penalty, but you will still have to pay income tax. So you'll want to be careful with those withdrawals. Does that answer your question? So
you mentioned a traditional IRA. Is that, so I don't have, like, my company, I've heard of 401ks. I don't have that. I've never had that. So what are my options for a retirement account?
Yeah, so once you've gotten through the debt piece and you've got your safety net of cash for expenses, then you want to think about taking your additional cash and putting it either in the market like we've talked about for the long term or into a retirement plan. If you put your money into a traditional IRA, you will get a deduction on your tax return. So that money goes in there what we call pre-tax or tax-free. So you would get, that would be helpful if there's a year where you maybe owe a little bit more money than you expected, right? So you have some cash on hand, you file your tax return, it says you owe some money, but if you contribute to a traditional IRA, you might actually save yourself some tax dollars, right? And you're planning for the future. So it's a two-way win. The other option is if you don't need the cash, a favorable long-term strategy is a Roth IRA. So the Roth IRA, any money you contribute, you pay tax on today, but any growth in that account is tax-free upon withdrawal. So let's say you're 25 years old and you start a Roth IRA and you don't touch the money until you're 60 years old, any growth on that money could be triple what you put in, could be quadruple what you put in when you were 25, would be tax-free when you withdraw it. So that's
that
a big,
pretty great.
It is.
Tax-free sounds better than paying taxes. To me, it sounds like, well, why wouldn't I just have a Roth IRA? So why might I want to choose a traditional versus a Roth and kind of vice versa?
You might choose a traditional if you need the tax deduction. So let's say, this is going to be a far-reaching example, but let's just walk through it. So you have a typical year, you have a good year of employment, you inherit some money from the passing of an older relative, and all of a sudden your tax rate is 30%. Okay, you had a really good year, 30%, you're making over six figures, okay? You may want to take advantage of the traditional because you'll save 30% taxes on $6,000, right? And if you have multiple years like that in a row, like the economy is great, everybody's making a lot of money, it's advantageous to like put the money in at a higher tax rate, because when you retire, depending on your lifestyle, your tax rate could be lower, right? That would be the reason why you would do the traditional. But otherwise, if you expect to always be, living a similar life and have similar income and expenses, you're better off doing the Roth. That way that you can take advantage of that tax-free growth. My advice probably would be slightly different for someone who is maybe in their 50s. But any of the young people watching the podcast, the Roth IRA is a good tax saving strategy for the long term.
Most of the time. Is there anything else, any other advice that you would want to give our viewers just generally on saving or taxes or just their financial health?
I just, at the end of the day, you could go out and receive advice from financial planners, CPAs, consultants, but really what it's going to come down to is what you're comfortable doing. Like what is a comfort level for you? Because financials are often a stressor for people that maybe have other stressors in addition to finances. So it's really about finding that sweet spot that makes you feel comfortable with your finances, that it doesn't bring about more stress. So you wouldn't want to tie up money that you're going to need access to. You're not going to want to, spend money that you can't then pay for, as we talked about. I think Naomi may have mentioned about, paying off your credit cards to not incur that high interest rate that comes along with them. And so really, as you evaluate your risk tolerance for finances, it's going to come down to a very individualized plan for you.
Awesome. Well, Karen, thank you so much for answering all of our questions today. Thank you so much to FOH, to Focus on Health, for hosting us today, and to Perrier for being our sponsor for our Dry January initiative. And there's going to be lots of resources through the FOH website if you want to delve deeper into financial health. Thanks, everyone.
Thank you, guys. Bye.